I went from 6 figures of debt to becoming a millionaire by 40. And what I learned along the way is simple. Investing isn't something rich people do. Investing is the roadmap to become rich. In this video, I'm going to walk you through the 5 investments that actually built my net worth. Not theory, not hype, real moves that worked. And stay till the end, because the final chapter is where I break down the moonshot investment that can dramatically speed up your path to $1 million, if you understand how to approach it without gambling your future. I've also seen this work for dozens of people around the world who followed the same framework and hit 6- and 7-figure net worths. So no, this isn't just my story. You can absolutely do this too. Investment number 1 is going to catch you off guard. You're probably expecting stocks or real estate. And don't worry, we'll get there, including the investment that made me over $70,000 passively. But when I was starting out over $100,000 in debt, I didn't have extra money lying around. So the first investment that moved the needle wasn't financial, it was personal. I invested in myself. I learned skills that increased my income fast. Most people only think about investing in financial capital like stocks or bonds, or physical assets like property, gold, or commodities. But there's a third form of capital that almost no one talks about, and that's human capital, your skills, your earning ability. When you're early in your journey, this gives you the highest return by far because of leverage. You put $1,000 into learning a valuable skill, that skill helps you earn an extra $10,000 a year. Over 30 years, that's $300,000 in added income. Now invest that money at 10%. That turns into roughly $1.6 million. That original $1,000 didn't just grow, it multiplied. That's a 164,000% return. One skill increases income. Higher income fuels investing. Investing builds wealth. That's the multiplier effect. Now compare that to just throwing the same $1,000 into the market and hoping for 10%. No comparison. Between ages 27 and 32, I spent over $20,000 on courses, masterminds, coaches, and workshops. Leadership, communication, business skills. Did every investment work? Absolutely not. Some were a waste. But here's the key. The ones that worked paid for everything else. The return on skills is so high that you only need 1 out of 3 to hit. During that period, my income went from $5,000 a month to $50,000 a month. If you never invest because you don't have money, you stay stuck forever. Investing in your skills first is how you break that loop. Everything starts with betting on yourself. If you earn under $100,000 a year, this should be your top priority. Pick one skill. First, something you're genuinely interested in, because doing something you hate every day will burn you out fast. Second, something you can get competent at in about 90 days of focused work. Third, something people happily pay good money for. Think high-income skills. AI automation, copywriting, social media management, video editing, coaching, consulting, sales. Put your money into programs and mentors who have already done it. Shortcut the learning curve. Your only goal early on is simple. Get to $100,000 as fast as possible. Because once you cross that line, the game changes. And that's where investment number 2 comes in. Now that you're earning more, you need to grow your money and protect it. Because inflation is quietly eating everyone alive. Groceries that used to cost $300 now cost $500. Rent that was $1,300 is now $2,000. Money sitting in a bank account loses value every year. That's inflation. Stocks solve this problem. Historically, stock investors have beaten inflation by about 7% annually. Prices still rise, but you don't feel it as much, because your investments are working harder than inflation. Stocks make you money in 2 ways. The first is capital gains. Buy at $50, sell later at $200. That $150 difference is profit. The second is dividends. When you buy stock, you own part of a company. When the company earns profits, you get a slice. Those payments usually arrive quarterly. Dividends are my favorite kind of income. Completely passive. But instead of spending them, I reinvest them automatically. That's where compounding kicks in. Now your gains are earning gains. That's how investing $20 a day can turn into over $1 million in 30 years. Any extra money I had after bills, debt, and self-investment went into stocks every month through dollar-cost averaging. Most beginners think stock investing means picking winners like Apple or Nvidia. That's risky. Putting everything into a few companies can wipe you out. Just ask Enron investors or Kodak shareholders. Picking the next breakout stock takes experience, research, and luck. That's why I prefer index funds. An index fund is a basket of hundreds or thousands of companies. Instead of one big bet, you spread your risk. Think of it like food. You can order one massive entree and hope it's good, or you can get the sampler platter. If a few dishes aren't great, no big deal. You still win overall. That's diversification, and it makes investing calmer and smarter. My most successful stock investments live in 2 index funds. VTI, which gives exposure to over 3,500 U.S. companies. You basically own the entire U.S. economy. It also has very low fees, and fees matter. Even a 1% difference can cost you hundreds of thousands over time. The second fund is VXUS, which adds international exposure. Europe, Asia, emerging markets, because the world is bigger than just the US. Now, before we get to the next investment, I want you to notice something. Everything we've talked about so far is about building stability and compounding over time. The last investment flips that logic completely. It's the moonshot, high risk, high reward. And I'll show you exactly where it fits so it helps you, not hurts you. Next is real estate. Everyone talks about it. Passive income, wealth building, but most people don't have $200,000 for a down payment. And when things go wrong, they go very wrong. I once had a car crash into one of my rental properties. That cleanup took over a year. Real estate isn't as passive as it sounds. Before I owned property, I invested through REITs, real estate investment trusts. REITs own apartments, malls, offices, warehouses, data centers, and when you invest, you own a slice of that real estate. They're like real estate stocks. The best part? They're required to pay out 90% of their income as dividends. Passive rental income, without tenants calling you at midnight. I mainly hold VNQ for US exposure and VNQI for international real estate. That means I own pieces of property all over the world. That's how wealthy people think. Own assets. Don't just consume them. Now comes investment number 4. Making money matters. Keeping money matters more. Warren Buffett said it best. Rule 1, don't lose money. Rule 2, don't forget Rule 1. This is where bonds come in. Stocks give upside. Bonds give stability. With bonds, you're lending money and collecting interest. Your upside is limited, but your downside is protected. When markets crash, bonds usually stay steady. That's why I keep about 10% in bond index funds. Not to get rich, to stay rich. I use funds like VGIT and VGSH. And finally, investment number 5, the one which you were waiting for, the moonshot. High risk, high reward. Most people mess this up. They either go all in and blow up or avoid risk entirely and miss massive upside. For me, that moonshot has been Bitcoin. In 2020, it was around $10,000. By 2021, it hit $60,000. That's a 6x in 1 year. But plenty of people lost everything chasing nonsense coins. Here's the smart way. Small allocation. I've never put more than 5% into crypto, mostly Bitcoin. If it crashes, I'm fine. If it explodes, it changes my life. That's asymmetric upside. As governments print more money, people look for alternatives. Bitcoin has a fixed supply. That's why it's called digital gold. Even major firms now recommend small exposure. You can buy through regulated platforms or Bitcoin ETFs. Every investment we discussed can be started with as little as $100. Each one played a role in my journey. Pick one. Start. But knowing what to do is only half the game. Knowing what to avoid is just as important. In one of my videos, I've broken down the most common beginner mistakes that quietly drain your wealth. Watch that next. Subscribe to Sam Finance, and I'll see you there.